Your wage lands in the bank, and just like that, part of it is gone before you touch it. You pull up at a petrol station, while the numbers on the pump whirl. A quiet share flows to the treasury. You buy a coffee, tax hides in the foam. You book a flight, another fee slips away in the ticket price. Some charges shout from the bill, others hide behind numbers and codes. Politicians promise to tidy the system. Instead, the rule book grows thicker every year, causing some people now to question. Could we be losing half of what we earn to the taxman? Why does one neighbor pay more than the other? Does any of this cash reach hospitals, roads, and schools? This is Nexus-Feed Deep Dive. In this video, we travel through the pay slips and shop tills of Britain, America, Canada, and Europe. We meet old taxes that refuse to die, new taxes on crypto and carbon, and silent tricks like bracket creep or fiscal drag. By the end, you will know where your money goes, why it goes there, and which twists in the road may be just ahead. A tax is a compulsory payment demanded by government, collected without a direct promise of an individual return. Instead of purchasing a single service, citizens pour money into a common pool that pays for hospitals, police patrols, pension checks, streetlights, and, when necessary, aircraft carriers. Modern governments draw from three broad wells. They tap what we earn: wages, salaries, dividends, profits. They skim what we spend: shopping baskets, phone bills, hotel rooms, liters of fuel. Finally, they charge what we own: houses, plots of land, inherited estates, and in a few places even the mere fact of holding wealth. No single source proves reliable on its own. Consumption shrinks in recessions, payrolls sag when populations age, and capital flees when rates climb too high. Mixing the streams lets revenue keep flowing even when one river runs low. Some taxes stare the taxpayer in the face. Income tax in Britain and federal tax in America sit on every payslip, line by unmistakable line. A rate, a figure, a subtraction. The cost is clear. Yet, many charges blur into the background. A value-added tax is baked into the price of a croissant. Property tax hides inside a renter's monthly transfer to a landlord. Inheritance tax only shows its teeth when a family is grieving and rarely gets discussed in ordinary months. The layers go deeper still. British employees pay national insurance on every penny earned, which is separate from income tax. Yet businesses employing them must also hand the government an extra national insurance contribution worth 13.8% of every salary. Employees rarely see that extra contribution, but economists treat it as part of the true cost of labor. In the United States, the familiar 7.65% taken for Social Security and Medicare is only half the story. A matching share comes from the employer, and most experts believe that in time, workers feel the burden through lower wages. Inflation cloaks taxes in subtler fashion too. When prices rise, wages drift up to keep pace, and if tax thresholds remain frozen, earners slide into higher bands without any lawmaker lifting a finger. The public hardly notices until the end of the fiscal year, by which time the Treasury has pocketed billions through this quiet process known as bracket creep or fiscal drag. Excise duties are masters of disguise. Nearly half the pump price of petrol in the United Kingdom is tax. Yet the meter shows only a single figure. The same holds for a bottle of German beer, a French mobile phone, or a Canadian domestic flight. Duties are embedded in the final charge, invisible unless you search government spreadsheets. In Britain, personal income tax starts at 20% and climbs to 45%. On the same pay packet, the worker pays national insurance at 12% up to a threshold and 2% beyond, while the employer adds that 13.8% layer on the whole wage. A broad value-added tax of 20% covers most goods and many services. Council tax on each property funds local government. Stamp duty on house purchases can swallow tens of thousands of pounds at the point of sale. Fuel duty, air passenger duty, alcohol duties, and a scattering of green levies fill out the list. When the Organization for Economic Cooperation and Development tallies income plus payroll charges, it finds that a single childless worker sees roughly 1/3 of the total labor cost absorbed by tax before pay ever arrives. In the United States, federal income tax contains 7 brackets ranging from 10 to 37%, and 41 of the 50 states lay on their own taxes. America has no national value-added tax, but nearly every state, county, and city charges a sales levy that averages around 7% and can exceed 10% in parts of Tennessee or Louisiana. Social Security and Medicare draw 15.3% of pay in total, split between employee and employer. Employer-sponsored health insurance, exempt from income tax, changes the feel of the system but does not remove the cost. A portion comes from wages that might otherwise have reached a household's wallet. When the OECD adds income and payroll taxes together, the typical American labor wage approaches 30%, lower than Belgium's or France's, yet far from negligible. Canada blends a progressive federal income tax with provincial schedules that vary from the gentle in Alberta to the steep in Quebec. The Canada Pension Plan, or in Quebec its twin plan, takes just under 6% from each side of the payroll. A 5% goods and services tax applies nationwide. Most provinces harmonize with or pile on top of it, producing combined sales taxes that reach 12 to 15% in many regions. Since 2019, a federal carbon price has raised fuel and heating bills, but also delivers quarterly rebates to households. When wages, sales, property, and carbon levies are counted together, Canada's average tax wedge edges above the British and American level, though benefits such as publicly funded healthcare soften public anger. Across the European Union, the standard value-added tax hovers near 22%, although groceries, books, and public transport often qualify for reduced bans. Germany's income tax peaks at 45% and levies a solidarity surcharge left over from financing reunification. Belgium couples steep payroll contributions with a top marginal rate above 50, giving it the heaviest labor wedge in the developed world. France piles employer social charges worth almost 1/3 of gross pay on top of wages, exchanging that burden for subsidized childcare, rail passes, and nearly tuition-free universities. Nordic nations push even higher rates, yet international surveys continue to rank them among the happiest societies, a reminder that trust in government and visible public benefit can soften the sting of taxation. The first purpose of taxation is simply to generate revenue. Modern states must finance clinics, motorways, courts, pensions, satellites, and sometimes wars, costs that private charity cannot reliably meet. The second purpose is insurance across the life cycle. Contributions paid while a person is young and healthy reappear decades later as a pension, a medical service, or a disability allowance, spreading risk across millions of citizens and many years. Third comes redistribution. Untouched markets tend to concentrate resources at the top, yet taxes blended with transfers lower inequality by about 1/4 across the OECD and by 1/3 in Scandinavia. Finally, taxes shape behavior. A high duty on cigarettes curbs smoking. A levy on sugary drinks nudges consumption away from empty calories. Carbon pricing nudges factories and drivers toward cleaner energy. In each case, the same pound both raises funds and tilts choices. The system works, yet never perfectly. Public services function. Sin taxes reduce harm, but structural deficits remain common, and the paperwork burden has become a cost all its own. American taxpayers log billions of hours completing forms, while British businesses negotiate ever thicker HMRC manuals. Compliance time, accountants' fees, and litigation risk act like a shadow tax that rarely appears in headline figures. There is the question of whether we lose half of our earnings to the taxman. And the truth will depend on where one lives and how the calculation is done. Imagine a British employee on £35,000 a year. Income tax removes roughly $4,500. Employee national insurance takes $2,000 more. Together, the visible charge equals about 19% of gross pay. Add the employer's national insurance contribution, which never shows on the payslip, but is nonetheless part of the government's cut of the labor cost, and the share leaps to 31%. Suppose that worker spends 2/3 of their net income on items that carry the full 20% VAT. Doing so hands another 5 percentage points of the original wage to the Treasury. Council tax on a modest flat, fuel duty on commuting, and the occasional stamp duty hit on a future house move all add to the lifetime picture. For high earners or heavy consumers, the effective burden can brush the 50% mark, but for the average household, the rate sits lower. Shift the scene to Missouri and a salary of $70,000. Federal income tax, payroll clips, and a mild state levy eat perhaps 22%. Employer payroll adds another slice. Sales tax, petrol tax, and small excises lift the figure again. That said, the final share rarely tops 1/3. Ontario offers a midway case. Federal and provincial income taxes, payroll, sales taxes, property assessments, and carbon charges stack up to roughly 36% for a typical family. High, but still some distance from the half-wage slogan. One reason tax codes keep growing is historical inertia. For example, the United Kingdom still collects stamp duty first imposed in the late 17th century to fund a war against France, while the United States kept a telephone excise born in 1898 to finance the Spanish-American War, long after the conflict had faded from memory. Laws that raise money rarely vanish. Politics adds its own weight. Mortgage interest relief survives in America because homeowners vote in vast numbers. French restaurateurs enjoy a lower VAT because their lobby fought fiercely for it during a recession. British pension tax relief expands whenever political parties court older voters. Each concession adds clauses, pages, and footnotes to the statute book. Federal and local layers build complexity upon complexity. A Canadian may face town, province, and Ottawa in one transaction, while a European citizen deals with national rules, plus directives from Brussels laid neatly on top. Technology changes the map as well. Value-added tax would have been impossible before modern bookkeeping. Today, digital services taxes hunt profits in the cloud, and real-time reporting systems allow revenue agencies to match invoices in seconds. Finally, stealth matters. Open rises in income tax trigger angry letters. Levies buried in shop prices or employer payrolls stir less heat, so governments often choose the quiet path. Each new quiet path, though, leaves behind another thread in the growing web. The future of tax filing is already here, moving from paper to phone screens. Estonia completes most returns in minutes. Britain's making tax digital, nudges businesses toward real-time online accounts. The United States is piloting free direct filing through the Internal Revenue Service, breaking a decades-long hold by private software firms. A global agreement intends to place a 15% floor under corporate profits so that companies cannot shift income seamlessly to tax havens. Countries are already sketching top-up charges to ensure big multinationals meet that minimum. Carbon pricing is spreading. Canada rebates revenue to households while raising pump prices. The European Union will soon impose a border adjustment on imported steel, aluminium, and cement tied to their climate footprint. The United States, under Biden's administration, took a different tack, showering the market with green tax credits to spur investment in clean power. Wealth itself is under renewed scrutiny. Norway and Spain tax net worth each year. Germany debates restoring a shelved levy. California has studied imposing one at the state level. Proponents speak of fairness. Critics fear flight of capital and talent. Cryptocurrency and artificial intelligence raise puzzles few legislators imagined a decade ago. Is mining a coin an act of production? Does an AI that trades autonomously owe income tax? And if so, who signs the return? Lawmakers scramble to keep pace with innovation that outruns statutes drafted in the typewriter age. One lesson stands out though: change never stops. Aging populations, climate stress, digital revolutions, and shifting politics guarantee that the argument over who pays, how much, and for what purpose will echo through every future budget speech. Tax remains the price we agree to pay for living together, yet the bill feels heavier because it is scattered across so many touchpoints. Some charges draw a bold line through a payslip, others hide in postage stamps and plane tickets, whilst many sink from view the instant a card reader beeps. Learning the layers does not lighten their weight, but it turns fog into a map, and maps let travelers choose a direction. So next time a restaurant bill lands with a jolt, remember the unseen passengers riding on that total: the nurse in accident and emergency, the teacher in the primary classroom, the engineer inspecting a bridge, the pensioner drawing income after decades of work, and yes, the interest on past debts that still waits to be paid. The maze will persist, yet clear eyes and honest debate can carve fairer, simpler paths through it. Keep asking questions, keep reading the fine print, and hold that map close. The world of taxation is complicated, but it belongs to all of us, and the route it takes tomorrow will be shaped by what we understand today. You've been watching Nexus-Feed Deep Dive. Consider subscribing to the channel for more in-depth analysis on stories that drive our global economy, politics, and technology. If you've learned a thing, please like and share the video. It helps us reach a wider audience. And join us in the comments section too. Until our next one, stay curious, stay critical, and keep safe.